It's been a nice rally for the last month, I would argue. And look, it's no secret that the big story this week is the Fed. And today is an anticipation of what we might hear from them tomorrow. This rally, much of it was predicated on the idea that there might be some sort of dovish language or some sort of language that would encourage people that there was, we'll call it a slowdown coming in hikes. But if everybody saw that JOLTS number today, that just reinforces the fact that this labor market continues to be tight, reinforces the Fed's discomfort with this tight labor market, and the fact that, in my opinion, they still need to hike through the end of the year and not necessarily stop after that.
It's a foregone conclusion. They have to. I mean, that's the whole idea. They've been pretty clear about this, and they would lose credibility, the Fed, if they didn't do this. Stephanie, I wonder, though, as you take a look at the way things are playing out right now, there's an argument to be made that the markets have fallen by enough where they've already factored in many of these moves. But then the other side of the argument is, no. Inflation is still a very persistent problem. We got a long ways to go. The terminal rate, so to speak, is still way off in the distance.
Right. So for the Fed to pivot, they have two things that they're watching: jobs and inflation. And as Liz just mentioned, we just had 1 more million job openings out there. I mean, it was huge. That was a huge number, right? So the job market remains very strong. The inflation market, part of the market, is also very strong, right? I mean, you had an ECI at 5.2% year over year. You had core PCE at 4.9% year over year. That's well above the 2% that the Fed really wants. So I don't think the Fed is going to pivot. And I, by the way, don't even care if they do 50 or 75 in December, because it's not going to matter. They're going to have to stay higher for longer. And that's why I don't think they're going to pivot. And that's why we're rallying. We could give it back. Now, that being said, we're down 19% on the year, right? Expectations are really low. Sentiment is really, really low. And seasonally, this is a good time in the marketplace. The fourth quarter is usually the strongest, especially after midterm elections. So I get why we're rallying, but I don't think it's because of the pivot, and I don't expect the Fed to pivot.
So, Josh, there are so many arguments to be made right now that this is a situation going to the fourth quarter, that seasonably strong time of year. We've got the midterms as a big catalyst. You're just coming off the best month for the Dow since 1976 at this point. You could argue that every dip that's out there has been bought, at least for the last couple of weeks now. Is the path of least resistance to the upside at this stage or to the downside?
You know, people forget that there's a third choice, which is chop and flat. And that has really been the best bet to make this year. One of the things that we've been trying to do with our appearances here on the air every week is to just highlight this idea that when the VIX gets too elevated up into the mid-30s, no matter how you feel about Biden or the economy or China or whatever, that's the moment where you have to go out and find something to buy. Conversely, when things get a little bit too chilled out and we see that VIX drifting down 22, 21, that's when we're probably underpricing the risk of some sort of scary headline, whether it's on inflation or Eastern Europe. And that's the time to look at your portfolio and ask yourself, do I really want all 27 of these stocks? Maybe am I better off with 25? Or have I ridden this stock up too many points? So if you had been utilizing that framework as your playbook this year, you're having an okay year. It's not so terrible. So this idea of the path of least resistance, I wish I could tell you. I think we zoom back to highs. The market has gotten completely comfortable with 5% Fed funds rate. I don't think it has. And I don't think the economy is going to hold up that well as we get into Q1. It's just too high of a rate to assume that all of these great consumer businesses that make up the S&P can flourish in that environment. A lot of them just cannot, will not. I want to say one positive thing before I finish. If you know that's the environment, why don't you spend your time focusing instead on the types of sectors and ideas that work really well with higher costs in the economy and things where the consumer really has no choice. Natural gas has been a great play. We've talked about those names. I want to introduce another one. The insurance sector, almost every name in this group, the 40 names in the S&P 500 insurance sector are within 3 to 5% of record high prices. Almost all of them. Go pick one. I'm going to show you the ETF very quickly. Patty, give me IAK. This is the S&P 500 insurance ETF. It's got 40 some odd holdings. Look at this chart. There's like nothing like this in the market right now. It's up 10% year to date versus an S&P down 20. This is the type of area where you can find stocks that have charts that are going from the lower left to the upper right. They're not expensive, good dividends, huge pricing power, catastrophic weather events give them the ability to get higher policy renewal rates and higher prices for those policies. The market is responding. This is what you want to try to do this year, not worry about an overall melt up for the S&P.